Good afternoon, everybody.
Good afternoon,
Good
sir.
afternoon, sir.
Thank you. Uh, from this session, also we continue the chapter 2, and we already discussed a lot of stuffs in these slides. Right now, we move to the last class. We have discussed about primary market and secondary market also. And also we have discussed foreign exchange market and most importantly derivative market. And now we will move to the next area. So these are the samples of derivatives, right? We can refer it. I will upload in the LMS. So these are the samples of future contract. This is corn future, and this one is detailed product specification. Right. Now we'll study about financial instruments. Under this, let us see the introduction, and let us understand what is financial instruments. Financial instruments refers to those documents which represent financial claims on asset. It's a kind of document, right? In your day-to-day life, you also encounter with this kind of financial instrument, like you are keeping money in your hand, notes, no? That's one example of finance instrument. And if you deposit money in the bank in a fixed deposit, they will give you a certificate of fixed deposit. It's also a financial instrument. And your passbook instrument, the check, if you get any check, cash check or any cross check, is also a financial instrument. Simply it's a document. By using the document you can claim some sort of financial assets, or it make you obligations, it makes you due to someone else. The financial instrument refers to those documents which represent financial claims on asset. As discussed earlier, the financial asset refers to claim to the repayment of certain sum of money at the end of a specified period together with interest or dividend. Recall the example of a fixed deposit. You keep the certificate up to its mature period, say 3 month fixed deposit. So in the certificate they will clearly mention, so at what date you can claim your principal payment, on what rate of interest. If it is in case of shares or preferred shares, they will clearly mention. So what's the maturity if there, and when you are going to claim the dividend. So examples are bill of exchange, promissory notes, treasury bill, government bond, a deposit receipt, shares, debentures, etc. Financial instruments can also be called financial securities. Financial securities can be classified into primary or direct securities and secondary or indirect securities. So primary securities, it means these are the securities directly issued by the investors to ultimate sellers. For example, shares and debentures are issued directly to the public. So in these primary securities, there is no intermediaries. Directly the finance, the borrower and lenders encounter in transaction directly without the help of intermediaries, brokers or dealers. In other hand, secondary or indirect securities. So these are the securities issued by some intermediaries called financial intermediaries to ultimate savers. For example, a unit trust and mutual funds issue securities in the form of units to the public and the money pooled in invested in companies. You know, in the previous sessions, I have explained you the mutual fund and trust, unit trust. So what they do is they collect money from general public and they pool their money in one desk, and the mutual fund institute invest in shares or debenture or whatsoever investment potentials, investment opportunities. So here uh, the issuers or the borrowers are not directly encounter in transaction with the savers or investors, right? So say a company, this company issues shares. If the company issues shares to the investors directly, its time is called primary or direct security. In case if the company issues security through its dealers, agents, brokers, so that time it's called as secondary securities. And also we can divide the financial instrument in based on their maturity, basis of duration. Again, these securities may be classified on the basis of duration as follows. One, short-term securities, medium-term securities, and long-term securities. You know well what do you mean by short-term, medium-term, and long-term securities. So short-term securities are those which mature within a period of 1 year. Within a period of 1 year. So its lifetime is less than 12 months. For example, bill of exchange, treasury bill, etc. No, it is a short-term money market instrument, right? And the medium-term securities are those which have maturity period ranging between 1 year to 5 years, like debentures, which are maturing within 5 years. And long-term securities, normally government and large corporations are issuing long-term securities. So long-term securities are those which have a maturity period of more than 5 years. For example, government bonds maturing after 10 years. A financial instrument in Sri Lanka, we can find deposits. Say, if you deposit money in the bank, HNB, so in fixed deposit, they will give you a fixed deposit certificate. It's a financial instrument. Loan agreement. You know, if you uh, want money immediately, pawning center, the bank, you give your gold, your valuable jewelries in the bank. For that, the bank will give you a receipt that indicates the amount of money you have borrowed, rate of interest, and what you given them, right, for security purpose. Say the weight of gold, jewelry, right? So this sort of informations will you can find, and also it clearly explains what are the terms and conditions. If you fail to settle the money within stipulated period of time mentioned in the agreement, so what are the follow-ups will be taken by the banks. So such kind of information you can find there, right? And treasury bills and bonds. Treasury bills is a money market instrument. It's mature within 12-month periods, and bond it's capital market instrument. It takes a long period of time to mature. a repurchase agreement. So already they have issued securities to the investors in the market. Sometimes the companies are facing excess money, and they decide to repurchase. Already they have issued, and they are going to repurchase, return. The investors will return the securities to the issuing company, and they will give some certain amount of money on that. Commercial papers is a short-term instrument. It is issued by companies. It's like treasury bill. If government issued a loan instruments in the market for short-term purpose, it's called treasury. The same instrument issued by, if issued by the commercial companies, it's called as commercial paper. And corporate bonds and debenture, the bond can be issued by government as well as corporations, rated corporations, companies. A debenture also issued by the corporations, especially risky companies, specifically private companies. Asset-backed securities, right, to take loan for security purpose, they are given their assets, mortgages, right, mortgage. And financial leases. So if you want to buy us assets, so we can find, you can find the leaser, right? There's leasing companies, they will uh, finance you, and it will has an agreement. So that agreement is called as a financial lease agreement. Shares, you know well. So what do you mean by shares and financial derivatives? So I will see some examples. uh, some people may doesn't see the appearance of shares, debentures. Let us see. We will find some pictures in Google image, right? Right, debenture, right? So bond. So these are the bonds. You see, this is bond. It's like rupee notes. Right, this is an example. It's issued by the United States of America. You can find here. You know, it's a legal sentences we can find here. On the due date, and pay interest on the principal sum of the date hereof. You know, this is the interest rate. This is treasury bond. Treasury bond mean but it's a government bond. So value of the bond is a piece of bond, $10,000. Right, this the value of this certificate uh, is 10,000 US dollar. So treasury bond of 1994, dated on, right. So how many years it's dues? So it issued on 1979, and it's mature on 1994. Interest payable May 15. every year, May 15, it pays interest, and every May and November. It's a semi-annual bond. It's a semi-annual bond. So it issued based on the circular number 2379. So this is the bond. And you can find government treasury bill. Treasury bill is shorter period. No? You can find this one. Right. So 100,000 US dollar. So issue date it was October 9, 69, and due payable in 1970. It's uh, less than 12 months. You know, of October, November, December, January, February, March, April. 6 months. It matures in 6 months. And you can find shares, no, corporate company shares, ordinary shares. So this is stock. So which company issued? Anybody? Can you tell? So what is the value of this stock? Anybody of you? Can you tell? What is the value of this stock? How much? How much? It issued 1917. Its value how much? So what's the name of the company? Name of the company? No idea. Which company has issued this share? Western Maryland Railway Company has issued the share, and the 100, its value is 100. Yeah, right, 100. So we can download and we can read this, right? And a commercial paper, we'll see. So this is commercial paper. It's like a check note. Sent in Brazil, April 20th. It's a specimen, right? So it's like a check. Yeah, you can find signature and everything, right? So these are the examples for. So after accepted, they put seal, the paid seat like in the bank. They are put accepted seat, and right. Right. So these are the you can understand the things. Right. Right. And now we move to right here. So what the differences between debenture and bond? Uh, it's basically uh, the government normally issue bond. Uh, companies or if company issues that kind of bond, it's called debentures. So it's basically the differences arises due to the rating, the risk. When you give loan to the government, definitely the government will repay the loan. If you give money loan to any company, can you assure can you assure is right, can you assure whether it, it's risk, no, it's risk, isn't it? So if you give loan to the government, definitely they will give you. Generally speaking, finance instruments possess the following characteristics, features. Number one, most of the instruments can be easily transferred from one hand to another without any cumbersome formalities. So, the finance instrument you can quickly transfer, right? Like rupee note, you can very quickly sell it, you transfer. They have a ready market. They have a ready market where if you wish to sell, immediately you can sell it in the exchange. They can be bought and sold frequently, and thus trading in these securities is made possible. You can sell it as well as possible as you wish. So they process liquidity. You can trade it in lower transaction cost. So some instruments can be converted into cash readily. For instance, the bill of exchange can be converted into cash readily by means of discounting. Right? Most of the securities possess security value, it's kind of mortgage. They can they can be given as security for the purpose of raising loan. When they are issuing securities, they mortgage fixed assets. So it's then the lenders encounter less risk. Some securities enjoy tax status. Investment in securities are exempt from income tax. So they carry risk in the sense that there is uncertainty with regard to payment of principal or interest or dividend, as the case may be. Uncertainty. In case of shares, sometime it may be declared dividend, or in case of capital gain, Sometimes based on the market conditions, the price may be go up or go down. So based on these market conditions, the returns may be volatile. It deviates. It's high risk. So they carry risk in the sense that there is uncertainty with regard to payment of principal or interest or dividend in the case may be. So these instruments facilitate future trading so as to cover risk due to a price fluctuation, interest rate fluctuation, etc. So this instrument involves less handling cost since expenses involved in buying and selling these securities are generally much less. So when you if you wish to buy or sell the asset, you may end up with a less transaction cost. The return on these instruments is directly in proportion to the risk undertaken. So if you wish to uh, obtain high return, you have to face high risk. The compare the government bond and private companies debenture. If you wish to get more return, you have to face high risk. you know Rather than, if you are willing to get more return, you can buy debentures rather than investing your money in government bonds. So government bonds are less risky, and also they are giving less return, right? So if you give money in private banks, private institutes, their risk is high as well as return also high. So the return on these instruments is directly in the proportion of the risk undertaken. These instruments may be short term, or medium term, or long term, depending upon the maturity period of these instruments. Now we'll discuss about the participants in this financial market. Participants in the financial market. Financial participants are the issuers, issuing company, or if in case of government getting loan, so government become a issuing entity. Investors, those who have excess money for the purpose of getting return, they are invest their money in the exchange. And lead managers, those institutes or the people who helps to uh, issue more shares by the companies, and they are finding people's organizations able to contribute on share issues or debenture issues. They are finding people like brokers, and broker and dealers, they are in stock market, in buying and selling should be channeled through brokers and dealers. And depositories, in Sri Lankan context, CDS, Central Depository System, and custodians, registrars. Custodians means it's kind of security providers for the financial instruments, and registrars, the government authorized people or bodies to safeguard investors and issuers. In the financial system, this is an exchange. Financial system, you can find two parties mainly. Uh, One with surplus fund, they're always happy, right? And they invest in assets to gain more profit. And one with deficit fund, so almost they are not happy here, and they sell assets to get financing, right? They may sell fixed assets, physical assets. Here we are going to consider financial assets, in form of bond, debenture, stocks, like that. So everybody here participate in here. financial system. So here is buyer side and here seller side. So participants, issuers, investors, registrars, custodians, broker, a dealer, depositories, depository participants, clearing agents, lead managers. The participants of financial market can be classified as hedgers. So more basically, they are involving in stock market, financial market to hedge the risk rather than rather than earning profit. They are interested in reduce the risk, try to avoid losses, to avoid loss, to avoid potential losses. They are participate in the financial market. Speculators, the ultimate purpose is to make profit. So they are using the market conditions favorably. The ultimate purpose is make profit, make money. And arbitrages, the transaction, no? So they are involving transactions. So activities differentiate the hedges, speculators, and arbitrages. We already discussed about the behaviors you may study in previous semesters in other subjects. So it's up to you. Can do that part. Issuers. Issue, I mean, those the entity or the party, they are facing deficit, shortage of money, shortage of fund. So to raise fund, they are issuing financial instruments. The issuers, the instrument may be in the form of stocks, debenture, bonds, promissory notes, bill of exchange, and commercial paper, and treasury bill, treasury bond, whatever the form, because they need money. So issuers develop securities in the form of stocks, common shares, preferred shares, debentures, like that, based on their requirement, based on their preferences. And register, that's securities. So the first they develop the documents and they register in the system, register securities, and after they authorized to sell it, they can sell the securities in public markets. So what are the responsibilities of the issuers? Responsibilities are the obligation of the issue. So at the time of issue, they have some sort of obligations. So they have to fulfill, so, accordingly. And reporting financial conditions and material developments. Once they issue securities, they have to update about the financial conditions. So they have to publish annual reports, and in case of extraordinary activities, they have to disclose, they have to update about these things to their investors. Operational activities as required by regulations of their jurisdictions. So it's based on their country's jurisdiction, legal system. They have to uh, update, they have to give information to the investors. So issuers can be a domestic, local issuers or international issuers. So issuers include government, sometimes government. If government need money, they can issue a bond. You may heard about bond scheme in the good governance in the previous government. And investment trust. Investment trust also can issue bond and kind of shares. And private corporations, private companies also can issue. The issue depends on the demand side. The demand is created by the investors, right? The investors are selling the bond in the market. The price is fixed based on the demand. Investors, if there are many people, many investors in the market, and it can sell at high price. So investors, second one is investors. Earlier we have discussed about issuers. Now we discuss about issue investors. There's, investors are the participants. The ultimate purpose is getting return. So they rely on fundamental analysis of investment decisions. The investors look at every corner of the issuers. They are assessing their risk and return. So goal is capital gain. Goal is capital gain. A lead manager, at the time of IPO, the private company going to transform as a public company by issuing shares at the first time to the public through exchange. So it's called IPO, initial public offering. So when the company try to sell shares to the